Good afternoon and welcome back to the 5th East African Banking and Microfinance Forum 2022. We trust you've all had a hearty lunch and a good break and are now energized for the afternoon session. We're going to kick off with probably what might be the highlight discussion of today on promoting agriculture and agribusiness in Africa. As you can see, the stage is all set for a very lively discussion on this key topic. At this juncture, I'd like to invite our moderator for this panel, Dr. Agnes Kalibata, President of AGRA, to come up. We're also going to have participation by Nuno Santos virtually from the European Investment Bank. We also have Mr. Adolfo from the EU delegation. Please come up and join the panel. Mr. Chris Isaacs, Ms. Ruja Johnston, Mr. Giovanni Munoz, Dr. Maxwell Mutema, and Ms. Shiromwangi. You're all very welcome to come up.
Good afternoon. Good afternoon. Thank you. So that's the idea, that we have a lively conversation this afternoon. We are going to be talking about a very interesting topic. And we come here in the context of, let me just check, the fifth East African Banking and Microfinance Forum, hosted by the Trade and Development Bank in collaboration with the European Investment Bank. And we are very excited to have a really interesting panel of people that work in this sector and have been working in this sector for some time. We also do have someone who will be joining us to present a keynote online. Let me just start by saying that I welcome this conversation at this point in time. I work in the agriculture sector, and as someone that works in this sector, one of the things we always talk about as the biggest constraint of how to grow the sector is finance. So I really want to applaud the organizers of the conference for putting this as a excuse me, as one of the critical topics we need to be taking on, and for inviting such a panel to have this conversation with. So I'm very excited because I'm going to push the limits here. I work on the side where we need finance, and you work on the side where you have the money, right? So the idea is that we do push the envelope here. Let me introduce our keynote speaker today. We are joined by Nuno Santos. He's a senior economist at the FAO Investment Center. He comes to the FAO Investment Center from the OECD. He was in banking. And then at the FAO Investment Center, he focuses on analytics and advisory support to improving agri-food policies, increasing access to finance, and enabling sustainable investments. I don't think we could have a better person in terms of introducing how this panel gets to have a conversation. So over to you, Nuno Santos. I hope I'm pronouncing your name right. Over to you, and welcome.
Hi, and thank you very much, Ms. Kalibata. It's really a pleasure to be with you and with such a distinguished panel. I would like to thank everyone. I wanted to make sure everyone's hearing me well.
Yes, we are hearing you.
Yes?
Yes,
okay.
Loud and clear.
Excellent, thank you very much. So I hope you had a good lunch and people are not too tired. I'm really happy to be here. We, as you know, as you just said, I'm with FAO's Investment Center, and we are a specialized center. We at FAO, we focus on public and private investment and finance solutions for more sustainable agri-food systems. So we work in this ecosystem where there are impact funds, blended finance, supporting also development banks. And I'm very happy to see some of our partners there, like from the EU, and very happy to see Adolfo. So we support about 7 billion of public and private investment in agri-food annually at the global level, from very large, so ranging from very large sovereign lending operations to investment in agri-SMEs. So my presentation will be about just providing a short introduction. I have 4 slides. And it's about just giving you some inputs on the situation in East Africa, and hopefully to help shape the discussion, which I'm sure will be very interesting. So to start, I would say that agri-food systems, and this is, I guess, not a novelty for anyone in the room, but extremely important in the region, agri-food systems. The figure I've put there of 15% is for East and Southern Africa. In East Africa, agriculture represents much more of GDP in many countries, above 30% in Ethiopia, around 20% in Kenya, and so on. Also in employment, it's really important. The rural areas and employment in agriculture is super important in the region. But we are also in a very difficult historical period with equally challenging regional outlook. So in this context, I think business as usual is not sufficient. And hopefully this forum will offer a space to take stock of what has been done and bring to the table some innovative approaches to what can be done. Africa is the region where the number of hungry people has increased the most since the launch of the Sustainable Development Agenda in 2015. Continent has accounted for 50% of the global increase in actual number of undernourished people. And if you zoom in at the sub-regional level, the prevalence rate in East Africa is of the prevalence rate of undernourished people is about 30% of the population and has increased since 2015 following earlier gains. So with that, it means that the region is about 3 times the prevalence rate that you can find at the global level in terms of hunger. And in absolute terms, with more than 136 million undernourished people, the East Africa accounts for almost half of Africa's population facing hunger. So, and about 18% of the world's population affected by hunger. So these are very striking estimates, which I think is important to keep in the back of our heads when we're dealing with the sector. But I think one important takeaway from this introduction is that these vulnerabilities are not just linked to these recent crises since 2019, COVID, the war in Ukraine, and that we've heard a lot this morning, but they already preceded that. And so we're talking about crises that have been going on for a while and to which we need to find solutions. Also, the region is confronted with compounding crises in specific countries. And when you can see from this map, which brings in all the hunger hotspots in the world, you see that a lot is focused in the region. And most importantly, you find all sorts of reasons for it, from climate to also conflict behind many of these hunger hotspots. So this is an important situation and specifically a difficult one, as East Africa's population, which is in catastrophe phase, so in the IPC it means phase 5, accounted for almost 90% of the global population over last year that was in this situation of phase 5 in catastrophic terms in terms of hunger hotspots. So that's very important. Now, in terms of the outlook now, on the short term, it's not particularly rosy. So we have discussed some of that already today, also at the macro in the macro front. So the issue of budgets and the issue of indebtedness and the ability of governments to the fiscal space to counteract the current situation. We will continue to see, and it's ongoing, these ongoing climate change impacts, and this adds to problems that the region is already facing. So we have droughts, we have floods in many of the countries in the region, but also we have a big question mark in terms of fertilizer use because of the increase in prices, and the fact that this may lead to even lower fertilizer applications, which in many cases in Africa are already suboptimal to attain or to reduce the yield gaps. So this can then aggravate productivity, and this is a big issue in a region where there's in many countries already a dependency of imports from several which can be sizable, as you can see in the graph, which is just focused on wheat import dependency from Russian Federation and Ukraine, which is an analysis that FAO did some months ago. And it was, you can see several countries in the region which have quite a sizable dependency ratio from wheat imports from the Russian Federation and Ukraine. So on top of these issues, we have access to finance, which is, I think, one of the key themes today. And this is not entirely new. So as I said, it's not just, it may now worsen because of deteriorating loan portfolios, which may lead to commercial banks and financial institutions taking a more cautious approach. But we are talking about a situation where just even before that, we had ample evidence of a financing gap, particularly for agri-SMEs and for agriculture in general. So we have multiple reports focusing on how many types of financial products, from equity for early stage agri-food businesses to trade finance, might be under financed and so on. So just a final slide on what can be done about it. I think the good news is that there's massive upside. So we're talking about, if we talk about sub-Saharan Africa, and I think Ms. Kalibata is in a good situation to discuss that in terms of the potential increase in yields that can be achieved with the right practices. There's a huge upside for productivity improvements, with optimization of input usage, with improved production technologies overall, and also an opportunity to build greener food systems. There's also in a sector that is by and large labor intensive, a young population, and this can also constitute an asset in building the sector in the region. Climate adaptation will be key as a focus of investments. And this, I think my colleague Ruja will be saying a few more detailed words on this. So I'll leave it aside, but this is clearly something that is needed from the farm up to the final product in agri-food systems. Diversification of sourcing for key inputs and commodities is part of that. But also development of regional markets, and I'm happy to have heard that also to this morning, the fact that there's an opportunity to develop more regional markets with neighboring countries and within countries to be able to improve resilience. Also, and this is, I hope Chris Isaac and others could talk about it, the adding value locally. So all these SMEs that are at the processing stage, how they link with smallholders, how to make financing available for them, and the difficulties in doing that, even with blended finance, how to scale that up. And so I think there's a lot to be done. And I hope we will have an exciting panel discussion. I'll leave this at that, and without further ado, also pass the floor to Ms. Kalibata to kick off the session. Thank you.
Thank you so much, Nuno. You bring out a whole lot of things that are going on in the sector. I just wanted to underscore that despite the challenges the sector has, it's actually a $1 trillion industry. A recent World Bank report shows that this is one of the sectors that could actually transform how we do business. And you know, with 65% of your population in the agriculture sector, it's really, really important that we find a way of mainstreaming how these people participate in our economies. Otherwise, we end up cutting ourselves short, especially if you're in the banking sector or in the sector of providing resources. So I'm going to go to our panel. I have a few questions that really to kick us off in terms of more general perspective. I want to get a sense of some of that, how we overcome some of the challenges, but also what you see as some of the biggest opportunities of the sector. And I want to start with you, Shiru, at the very end. I want to check with you what you see as the critical factors that challenge your ability to engage in the agricultural sector as someone who is providing finance? What do you see as some of the critical factors that would make it difficult for you to engage?
Thank you, Dr. Kalibata. And I think the first comment I will make is that we are an impact investor. And therefore, when we think about funding, we think about the funding to smallholder farmers. And that is an area that we find to be critically underfunded. And it is a chronic condition in our region. And given that our agricultural systems are very dependent on food production coming from smallholder farmers, we're very clear in our approach. We believe that for agriculture to flourish, smallholder farmers require access to an interdependent set of goods and services. It is not enough to just address the challenges of production alone. And to that, and keeping that in mind, when we think about funding, we look for companies that will strategically and intentionally source from smallholder farmers, those that will improve yields and connect to markets, because if we do not have market integrated production, we are indeed not able to achieve our ultimate goals. We also look for and are very interested in financing for those models that transform on-farm production. We've all seen the vagaries of weather, and models that build new and transparent markets. I think that is critical for the sector to flourish. And finally, the models that will provide access to finance and insurance. We are very clear that unless we can address these elements, which are all very high risk, these are very high risk models, we will require very patient capital and probably underestimated returns. We believe that when we look at agriculture, the requirement for returns that are in line with other sectors is actually very optimistic. If we are willing and looking to transform the sector, we need to look at patient capital, we need to look to long-term systems, we need to look to systems that will address the entire vertical from smallholder farmers to market linkage, and ultimately transparency of markets, because that will then begin to address the ability to have our mobile and very young populations enter into the space.
Thank you so much. And again, you remind us we are here because we are funding agribusinesses in the sector, and you kept bringing that point back. Maybe I come back to you, Chris. We are working at a time of the Russia-Ukraine crisis, and where it's impacting our ability to do business as we know it in the agricultural sector, from food crisis itself to fertilizer crisis to fuel crisis. How is that impacting who you're working with, how you do business?
Is this working? It's clearly been a tough period for agribusinesses with the sharp increase in input costs, but I'd say there is a silver lining. Firstly, we have seen the price of fertilizer, the price of feed inputs increasing, sometimes by 50 to 100%. I was looking at the pricing just today of maize and soya in the East Africa region. It's the first time I've seen both maize and soya at above $500 per ton in Kenya, Uganda, and Rwanda simultaneously. I don't remember seeing that before. So we work with poultry businesses, with aquaculture businesses. They've seen the feed cost increase substantially. Now, what impact does that have on you as a business? Well, if you can't pass that cost on to your consumer, then you see squeezed margins and lower profitability. And companies have been reluctant or unable to pass those costs increases on to their end consumers because there is a cost of living crisis. But the silver lining, I would say, is that we're seeing that if companies can absorb that shock and gradually raise prices, the underlying demand is robust because these economies are growing and people want access to good quality locally produced foodstuffs. So if you can get a good quality product to the market at a cost-effective price, there is that demand, and companies will be able to get through this period, I think.
No, thank you. And let me come to you, Giovanni. You work with the EIB, right? European Investment Bank, right? There's a bigger issue here. There's the whole debt crisis situation that is going on, especially with a number of developing countries following the COVID-19 crisis, and now the whole crisis as a result of Russia-Ukraine. How is this impacting your ability to do business, the debt crisis?
Well, yes. Unfortunately, it does have an impact in terms of the capacity of the sector, of the banking sector, to borrow, and that includes also the commercial banks, because it's something that probably not everybody realizes. But whenever a country is downgraded, all the entities, the financial entities within the government are somehow priced or linked to that, and therefore, basically, the price of borrowing for every single bank goes up. So yeah, that definitely increases let's say, the risk of the sector, creates an additional problem for the financial sector to be able to access lending at a competitive price.
Good, thank you. And let me come to you, Ruja, right? How can investment support food systems transformation, and what is the business case for that? What, in your view, needs to be done, especially from blended finance perspective? Because, again, all of you are looking at different financial instruments. But how do you bring that together at FAO and try to support borrowing institutions to get money, addressing some of the questions that Shiru talked about? I think it's working. It's supposed to be working.
Food system transformation.
Is that working?
It's working now? Can you hear me? Great. Food system transformation really is at the heart of being able to feed the future. It requires a holistic approach to the multiple challenges which we're facing today. And it is a long list of challenges. High rates of poverty, rising food insecurity, unplanned rapid urbanization, water scarcity, ecosystem loss, and all of it obviously in the context of a climate change crisis which is increasingly dictating the agenda. In addressing these challenges, we have also realized that we really need to come up with comprehensive and system-level solutions. We need a shift of paradigm where we align the approaches and priorities between climate science, agriculture and food, environmental regulation and investment in order to ensure coherence and impact of the public and private financing that is going into agri-food transformation. We need to also increase our attention to data and evidence-driven decision-making, which needs to lead the transformation and innovation efforts. Adaptation for the agriculture sector requires both public and private finance and a multitude of different investments, from climate-proofing traditional farming systems and transforming the way we produce our food, to technology and digitization, which are means to improve the outcomes and the efficiencies of these systems, which are then linked to professionalization. Are today's farmers able to transform? Are they able to capitalize on the technologies available and to link to finance? We need to invest public resources in updating our regulation system with regards to safety and quality standards, because climate change is bringing about also serious issues about food safety and quality, such as this region has faced on the subject of aflatoxin in basic staple crops, such as maize. Linked to ecosystem health. In other words, it is a very complex matter. It is really requiring that we look at agriculture not as primary production, but agriculture as part of an agri-food system, which extends from agricultural inputs to agricultural production, agricultural transformation, to the final consumer, and the final consumer's consciousness and awareness of what goes into putting food on the table. Now I'd like to just very quickly address the issue of the business case for investing in adaptation, Because today we really are talking about adaptation. There's no ignoring climate change. There's no going back. And the Global Center on Adaptation last year issued a report on the state and trends in adaptation, which focused on how adaptation can make Africa safer, greener, and more prosperous in a warming world. According to this report, we have the opportunity to adapt successfully to both climate and demographic changes and see enormous benefits brought about by the transformation of the agri-food system to be more socially and economically sustainable, inclusive, and climate resilient. Studies focusing on Africa show that the benefits of adaptation measures are almost always more than twice the cost and often more than 5 times the cost of inaction. The World Bank also recently published some interesting figures that demonstrated that, for example, water management in terms of increasing water use efficiencies, water harvesting, storage, irrigation, and general improvements in the management of this scarce resource, the adaptation cost globally is estimated to be about 6.1 billion versus the cost of inaction, which is currently estimated at about over $90 billion. Therefore, there is really a business case for putting money into adaptation, which, as I said at the beginning of my intervention, requires us to think in a more complex systems way. In order to impact agriculture, we must look at the entire agri-food system, from R&D to traditional food production, to markets, to improved efficiencies of food distribution, logistics, off-grid solutions, and the kind of technologies we use to reduce post-harvest food waste and losses. In other words, it is a very, very challenging world, and it does require for public and private sector to come together like never before.
So thank you so much for calling out public-private, the need for public-private investments and the need for public-private engagement to be able to deal with the challenge, the complexity of the food system, right? Which is really the reason we had the food system meetings and conversation last year, so that we can bring out the quality of the discussions that need to be had here. But let me come to you, Adolfo. You represent the European Union in Kenya, right? And that puts you in a very difficult position because you're trying to move inclusion here. Part of what you do on the agenda is ensuring that there's the right level of inclusion, the development is happening among your member states and countries you're supporting, but also you're trying to move trade. And one of the questions I have in your everyday work, when you look at your everyday work, what do you see as the number 1 or 2 challenges that make it very difficult to finance the agricultural sector?
This is on, eh? Okay. Well, good afternoon to everyone. First of all, it's a pleasure to be here with all of you in the panel. Yeah, that is a very pertinent question. I mean, we have been talking about it now for a while. Even our colleague and friend from Akuma has mentioned that one of the problems that we have is that the agriculture sector is underfunded. We know that it's not even underfunded, but because it's also growing. The agriculture production is growing, so the need for capital is also growing. But let me focus a little bit on the challenges that SMEs and mid-caps face, because I don't want to go into the smallholder farmers segment, because that one we know that eventually, I mean, they are accessing capital from family, friends, from mobile money, etc. That comes even from the Fin Access report that we have for Kenya. So let me focus on the issues that SMEs and mid-caps companies they have from the different sources of capital that I would divide actually into 3. One of them is the banking sector. We have many representatives of the banking sector here today, different banks. The other one is the private equity, and we also have representatives here from AgDevCO and Acumen as well. And I would add one more, that is the access of capital from the government, where we can maybe mention the Agricultural Finance Corporation, etc. So going back to the banking sector, and let me use some of the statistics that Dr. Evans mentioned today in the morning when he was talking about the amount of money, the private sector credit that is available. Well, we see it's around 40% of the GDP, so let's round it out at 50 billion. And then from those 50 billion, we have to see how much is being dedicated to agriculture. And now there, the definition of agriculture also is important, because if we look at the statistics of both AIB, the study that you have done, or the Central Bank of Kenya, pure agriculture is 4%, but it's not including manufacturing, that it should be included according to many different sources. So if we put together agriculture plus manufacturing, maybe we can go up to 20%. 20% of the 50 billion, that is 10 billion. So we have approximately 10 billion of capital from the banking sector into agriculture. But obviously, looking at the needs of the country and the need of growing, that is not enough. I mean, we need to increase the amount. But then when we go back to the banking sector, you always say, you know, but lending to agriculture is very risky. It's very risky. You have a number of NPLs. Even if the NPLs of the agriculture sector is similar to the other sectors, still it's very risky. It takes a lot of efforts to lend to the agriculture sector. So first thing we have to try to look at is how we support the banking sector to lend more. How we reduce the risk of the banking sector to lend more. Okay, so we're trying that from different ways. We're trying that from actually partnering with some of our European DFIs, including the European Investment Bank, but also some of our colleagues from Proparco or FMO or others, that they actually provide guarantees to the banks to lend to the agriculture sector. So we're doing that, but some of those operations are in the range of 10, 20 million, okay? Well, they are, yeah, 10, 20 million, not billion. Yeah. So we have some other kind of initiatives here. Maybe you mentioned about, maybe you heard about this Africa Guarantee Fund, but again, Africa Guarantee Fund provides guarantees to the Kenyan banks of the range of 100 to 200 million in Kenya, you know? Plus maybe other initiatives in other countries in East Africa, like in Uganda, you have ABI development. Anyhow, the point is that even if we put all of those together, we are very far from being able to guarantee even 50% of the 10 billion. You know? So the solution will be to find a bigger kind of guarantee facility that still is not there in the market. Okay. So that is one of the kind of big challenges that we have, because risk, but we don't have enough big guarantee funds to guarantee the banking sector. That is from the banking sector, but then from the private equity funds, they also have a risk. And even if the private equity funds amount of money for agriculture is growing, you also need your own de-risking mechanisms. Otherwise, they will have difficulties to invest, you know. So I would say that that is one of the biggest challenges that we have, to be able to address the decreasing of the risk with an instrument that is of enough size of what the market needs.
No, thank you so much. And let me go straight to a bank, right, and try to see how they think about what you're doing right here, right? Let me go to TBD, right? Well, someone here wrote TBD, TDB. Yeah, so I'm told you have now a huge focus on agribusiness development, right? And you're in charge of value chain financing. What he's talking about with regards to access to guarantees, with regards to working with the equity and all that, is that making your investment decisions any easier? Are you making decisions faster? Or what are some of the challenges that are making it difficult for you to be lending to this sector?
Okay, good afternoon, participants. Thank you, Dr. Kalibata, for the opportunity to speak to this audience. I think just as a starting point, TDB indeed put a lot of focus on agriculture and agribusiness. I think as we all know and understand, Africa is already a net importer of food. We are the most food insecure continent on earth. And according to the World Bank, I think only 2 countries in Africa are described as food insecure, and that is South Africa and Uganda. Maybe there are more others, but generally Africa is a food insecure. So there is a lot of opportunities, and that's why as a bank we are focusing in that sector. As to the challenges, Dr. Kalibata, I will highlight a number of challenges. I think most challenges have already been highlighted. That's also the benefit of being the last speaker, because you just have to cherry pick a few things which have been left out. The rest have been said. But let me dwell on a number of challenges that we face in trying to invest in agriculture in Africa. By the way, we operate in all the COMESA countries, Southern and Eastern Africa, and in all those countries, we are trying to scout and look for opportunities to invest in Africa. So one of the challenges that I want to talk about is the issue of land tenure. Land tenure is a big elephant in the room when it comes to investment in agriculture, and there are a number of facets to land tenure. Informal land ownership, fragmentation in terms of some of the small sizes of hectareages or plot sizes that you have to deal with. And in as far as land tenure is concerned, academically and scholarly, some could argue that the farmers and the people on the land are secure and have no problems. But for a lending institution, a land tenure without predictability, certainty, and security of the tenure is just a major issue that we encounter. If you look at the history of Africa, when Africa got independence, most countries nationalized land as a way of moving away from the colonial era situation. But I want to challenge if there were African governments that we actually have to relook at the issue of land in terms of how private capital views and consider it. When bankers are put together with the lawyers and accountants, don't underestimate them. They have a group of very powerful people, of very I think, talented people in terms of making those decisions. If you look globally, 18% of registered property is what generates the rest of the economy. In Africa, Rwanda is one of the few countries that has decided, I think, to register most of the land and to make sure that the issue of land tenure is sorted. And you can easily see the pattern between clear property rights and registration and the institutional investments. I can go on for a day talking about land.
Yeah, maybe we leave it there.
So I can leave it there for now. So the next issue I also want to talk about are policy inconsistencies and unpredictability. It's a major issue that we encounter in countries that we are trying to invest. I think, again, it's an issue of government and policymakers to make sure that when any institution like TDB or any other wants to make some investments, there's need for predictability. There's also regulatory requirements. In Africa, they are complex, and many, including the countries we operate, you are dealing with a multiplicity of stakeholders and overlays and the duplications and the repetitions. We also face the issue of currency. This has already also been mentioned. Currency in terms of volatility vis-a-vis the local and exchange rate. It is a major problem because it's no point for a private bank or a private capital to invest in a country which you cannot get out your money after an investment. In terms of trade and commodities, the issues of information gaps in terms of the stocks, in terms of the import balances, in terms of the trade volumes. So those are some of the challenges. If I could take a challenge, thank you.
No, thank you so much, and you just highlighted a whole lot of challenges that had not been picked before. We are going to go on a second round of questions. We have about 30 minutes, minus a few. So I just want to make sure that we really try to keep time in those questions. I'll come back to you, Shiru. I know that Acumen, the institution you work for, has been at this trying to finance the agricultural sector for the last, 18 years? You do use philanthropic money, but you also have a fund, right? The Resilience Fund. How does this work? Help us understand how you blend, basically, if I might use the word. How do you make it work? How does it work for you?
Thank you, Dr. Kalibata. I think I can begin by mentioning that Acumen has 3 different organizations operating within East Africa. And Acumen structures itself along pillars, the first pillar being Pioneer Investments, and the second pillar being Acumen Funds. I'm here representing the Pioneer Investments. What we do in the Pioneer Investments is we raise philanthropic capital because we are firm believers in patient capital to do what we call the hard work. We raise philanthropic capital. We deploy it in early stage SMEs, targeting businesses that are in agriculture, in education, and in energy. But for purposes of this discussion, I'm looking primarily at agriculture. And we are looking at the entire vertical. We are very clear that it has to be a systems conversation, as Roger said. And so the Acumen Pioneer Investments will take very long term with our investments. We will provide technical assistance. We will provide strategic advice. We will create and deliver networks to our investee companies. And we will work with them until they are capable of either scaling and growing, or we're able to catalyze additional capital to come in. ARAF, on the other hand, which is Acumen Resilient Agriculture Fund, is focused on companies that are already in growth stage with the ability to be highly scalable. So the investments will come in where they can see the potential for significant impact. Again, as I mentioned earlier, we are an impact investor. So what you may see is a continuum of capital. We take the early stage risk, we de-risk those investments, we walk with the companies to a stage of growth, and then at the point where we exit, companies or entities like ARAF and other such funds may be able to inject capital into those companies. And I think one of the examples that has been tabled here is Ethio Chicken. Acumen was one of the very first investors in Ethio Chicken when they were still debating on the chickens that they would need to be able to distribute within Ethiopia, the breeds and the dual purpose that was intended. And that investment went on to do very well. We exited. And as we look at it currently today, as Ethio Chicken scales to 7 other African countries, as mentioned by AgDevCO here, ARAF is one of the investors that has followed on to see how they can address challenges of food security and food sovereignty in these other markets. So this is the work that we do as Acumen, and that's a distinction. We also have an energy fund also that is registered in Kenya, but covering again the region. Our work is purely pioneer investments and taking in the early stage risk.
No, thank you for that, and we need that, and that's why I'm coming to you, Chris, right? She's talking about early stage risk. That is something I can definitely relate to. You're in this business, Chris, you're representing, you're the Chief Investment Officer of AgDevCO, and that's a huge responsibility. How do you avoid cherry picking, going with the guys that are doing well? You're looking to make money, but at the same time, you have a public responsibility to ensure that businesses grow in this landscape. do you see $3 million type of businesses a growth pathway for African businesses? Go ahead, Chris.
So firstly, let me say we invest about 40 to 50 million a year in the agriculture sector in Africa. We're an agriculture specialist, but to Adolfo's point, it's still a drop in the ocean. Are we cherry pickers? Yes, absolutely we are cherry pickers. We look at hundreds of business plans each year, and we're looking to select those businesses that can deliver impact at scale. We're looking to find the next Ethio chicken. And so we have to be pretty ruthless in picking the winners. We don't always get it right. We've made lots of mistakes, but we're looking for the very strongest management teams. We're looking for business models that already have some traction, and this perhaps comes to your challenge, which is an absolutely fair one. Today, we work with businesses that have already achieved a few $1 million of revenue. These are not the small SMEs. They're perhaps the mid-cap businesses in your language. So they've been through that early stage. In the past, AgDevCO did do the Pillar 1 type investments that Acumen do, and I'm happy to come back to that later if we have time. But are these bankable businesses? No, they're not. They're typically not yet profitable, often 4 to 5 years away from profitability. They're still pioneering new models, often in new markets. So to use the Ethio chicken example, the group is called Flow Equity. We're working with Flow Equity to take that model. We took it to Rwanda, where it was a brownfield site in Ruberizi. We took it to Uganda. We're now taking it to Kenya and to Ghana and to Cote d'Ivoire without any recourse to Ethio chicken. So we're taking effectively greenfield risk in all those operations. But we know the model works. We know it's high impact. We back the management team. A bank wouldn't take that risk, nor would a commercial private equity fund. And to explain, we're not a for-profit fund. We are backed by DFI investors and the UK government. We have to provide a return to our investors, but it's a modest return. We think, realistically, in this part of the market, single-digit net returns are achievable. That's not attractive to private capital yet. But if you can take Ethio chicken into 8 countries, absolutely in 5 years' time, that should be attractive to commercial capital. And perhaps relevant to this audience, we are crowding in the banks because we are supporting new business models, building those balance sheets, building their track record. And in every case where we invest, now there's a relationship with the local bank to finance working capital, and the bank takes confidence from the fact that it's a business that has equity funding behind it and has a sustainable future ahead of it. So yes, we're cherry pickers, but we crowd in rather than crowd out commercial capital if we possibly can. But these are difficult judgments to make. Okay,
very good. Listen, Jovan, I would be amiss if I didn't come to you after he tells me he's cherry picking, right? No. So I'm coming to you. You're investing a lot of money. You've just invested 50 million euros in credit, and you're investing with Equity Bank, right? The idea is really you're trying to make it possible for people like Chris that are looking to invest in equity, right? To be able to invest in businesses, in a few more businesses on the ground. So how is that working?
Well, we at the European Investment Bank do have a strong focus, I would say, in agriculture. One of the aspects that was mentioned by a previous speaker is that of having a focus on impact. And therefore, the operations we have, including like the one you mentioned here with Equity Bank in Kenya, is focused very much on that, on maximizing the impact, in that case, particularly for smallholder farmers. So what we have is, we responded to a very kind invitation from the European Union delegation here that had put together a program basically to support business development in the country. And as part of that package in which the delegation made available investment grants, then also the European Investment Bank came and in the market looked for banks, commercial banks interested in being part of this scheme. Being part of the scheme meant that we also received some resources from the EU delegation that we use in general I use this case as an example because we have similar operations in other countries, in Malawi, in Zambia, in Tanzania, where we receive resources from the EU delegation for different kind of financial instruments. In the case here, for example, we use it to be able to provide local currency. And providing local currency, I think, is key for the agricultural sector, particularly for that segment of the agricultural sector that focuses on the domestic market. I think too often we focus on exporting, which certainly is good and is great, but there is also another important segment when it comes to the impact on development, and that is the smaller companies that have mostly dependent on local markets. So being able to offer local currency was a great opportunity that we are doing in this case with Equity Bank here in Kenya. But we also use those resources, blended resources from the EU delegations, to finance other types of financial instruments, like, for example, partial portfolio guarantees. In some of the other cases that I mentioned in Zambia or in Malawi, we use those resources to do just that. So basically to address the problem that we have been talking here since this morning, and that is the risk and the risk aversion of the banks. I know that obviously, like every bank, we also have a risk management unit that is very risk adverse. But I think that actually, particularly in the agricultural sector, it's also a matter of getting to know the sector. When you get some confidence and you know the sector better, maybe you can price that risk in a better way. So actually, in this moment, for example, we have been hearing the whole day about how dire the situation is, and it is dire in many senses. But the fact that we have this year the record food prices worldwide, which we reached early this year in March, from the other point of view, from the entrepreneurial point of view, well, that actually looks to me like a very good opportunity. If you have good prices, then you should go and produce those commodities that are reaching those high prices. And I'm sure that's exactly what some entrepreneurs in the sector are doing. We are also discussing here tomorrow the African Continental Free Trade Agreement, and to entrepreneurs that also looks like great increase in market size. So those two things combined should actually make that should be some optimism, at least in the agricultural sector, to increase lending. We also use part of those resources that we receive for blending from the delegation to provide technical assistance, because we also believe, as it was mentioned earlier, that there is need to increase the capacity of the banks to better understand the sector, better assess the risk, and therefore better price the products. That is a key point that we see, and therefore we use part of the resources of technical assistance to support the banks in that process of strengthening their capacities. Sometimes when we have the opportunity, we also use that technical assistance to support directly final beneficiaries, because they also need support in terms of better tools to be able to prepare bankable projects, because often they might have a great idea, but if they don't materialize it, if they don't put it on paper in a manner that is understandable to the banks, then obviously they will have a hard time accessing those resources. Having said that, it's a pity that often many banks, not only here in Kenya, but all throughout the region, look mostly at the credit risk profile of the client without looking much at the business proposal, at the actual business case for the loan they are asking. And there are many very good tools out there to help final beneficiaries to prepare projects that can be interesting for a bank if the bank has the capacity to actually look into them and not only at the collateral. One last small thing is that actually it's true that most of these intermediated lending that we do through commercial banks, and as it was mentioned this morning by our Vice President, it includes also a new envelope we have in Tanzania for 350 million. It does often look at, or is focused on SMEs. But we also have learned through the case, for example, here on Equity Bank, that even though the original focus was on SMEs, they end up actually also, through their strong capacity they have also in lending directly to smallholder farmers, reach directly over 50,000 farmers here in Kenya. So there are some banks that have the capacity, and therefore some of our lending reaches also directly smallholder farmers. And well.
No, thank you so much, and I appreciate that. I was waiting to get back to Aldolfo on smallholder farmers get money from relatives. I'm coming back to you. So let me come to Ruja. Let me come to you. Listen, we're talking about risk, and there's no greater risk than climate risk that has come through. But also Giovanni has brought out the issue of technical support, and you support institutions to get funding from the Green Climate Fund. Can you give some really concrete examples of how that is working to support smallholder farmers?
Yes, FAO is an accredited entity along with UNDP, the UN Development Program, and one of the executing entities for the GCF. We've been working together since 2016 to scale up climate investments in high-impact projects across the world, trying to leverage global partnerships, catalyzing public and private investments in agriculture, forestry, and fisheries, and focusing on countries most vulnerable to climate change. However, only about 1.7% of climate finance in general, which is a fraction of what is needed, goes to small-scale farmers, which is really disproportionate to the level of vulnerability they have to climate change. It is difficult to estimate the magnitude of the investment required. However, a recent report by IFAD and the Climate Policy Initiative are quoting a figure of about 240 billion per year globally, US dollars, needed to address the financial needs of households and small-scale farmers in these vulnerable contexts. Therefore, really we are looking at a significantly underfinanced area of intervention. And again, going back to Bankable Project and the Green Climate Fund, the Investment Center is currently in the final stages of a preparation of a proposal to be financed by GSF for Malawi, where we're looking at combining ecosystems-based adaptation approaches with integrated landscape management and aiming to really restore degraded ecosystems and provide resilient food security systems as well as socioeconomic systems to smallholder farmers. Of course, this is meeting a lot of challenges because you have the challenge of transformation of traditional farming systems, which need to be addressed in many different ways, through technology, through innovation, through capacity building. And then when you come to the bankability, then you're looking at how could these transformational efforts be sustained, and how can the smallholding farmer community become economically and socially resilient? How can we also extend lending to that type of client? And going back to what my colleagues on the panel were saying, looking at creating agribusiness MSMEs that have bankable business plans. And it's a two-way engagement, because we need to work with the agri-food sector to be able to become resilient to climate challenges, which in a way de-risks the sector as such, because it reduces production fluctuations. We need to think about other innovative solutions, such as, for example, insurance for these businesses. We also need to look at the capacities of a lot of the smallholder farmers in terms of running these businesses and in terms of connecting with lenders. We also need to look at the capacity of lenders to engage with that kind of portfolio. And then going back to what was mentioned about land tenure, the issues of collateral, and so on. So really, it is, again, a very complex landscape. So looking at the bankability of climate investments, again, at this stage, we need to, again, think about bringing together public and private financing to de-risk and to help grow and transform sustainably before we can talk about commercial lending and a de-risked sector.
No, thank you. I don't have a sense of time. I was supposed to see time here. It's not showing. But if someone has a sense of time, so please. Okay, good, very good. We are doing well. Just microphone. No, I was saying we don't have a sense of time, but I do now have a sense of time. Listen, I'm coming back to you, Adolfo, and I'm leaving the last question for our host, TDB. We've had a lot of interventions from people. We've talked about guarantee facilities. We've talked about also forms of blended financial instruments. Do you think these are enough to get commercial banks to do what they need to be doing to move from the 3% you mentioned earlier to at least 10%? What else do we need to be doing, in your view?
Hello? Yes. Yeah, thank you for the question. I was thinking you were going to ask me why I say smallholder farmers only get money from the family members, but
You can. I'm interested. Please go ahead.
No, I'm not the one saying that, actually. I just saw it in the Fin Access report of FSD Kenya. That is actually very good, because you point out that smallholder farmers and the kind of the people that actually drive the agriculture, more than 60–70% of the money they get it either from shops or from family members or from relatives, or eventually sometimes from M-Pesa, but you know it's expensive, it's very expensive. So I'm not the one saying that. I mean, I just read it, and I can share it with you, no problem. So let me go back to what can be done, and let me go back again to what I was saying about the guaranteeing commercial banks. We have seen in other countries that actually guarantee companies have been set up with funds from the banks, because the banks, they also can invest in their own guarantee fund, from funds from development finance institutions also that they invest on that, and from funds from the government. And there are countries that they have substantial size of guarantee schemes for the agriculture sector. If we have 10 billion private sector credit for agriculture that is out there, you need to have a structure that is of similar size, or at least half of it. We don't have it in Kenya. I mean, we try our best to see how we can solve this problem, but we are just doing small things here, small things there, and yeah, we do that in partnership with AIB. I mean, Giovanni mentioned it, that we blend resources with them to do portfolio, I mean, agriculture portfolio guarantees for commercial banks that commercial banks can access. We do it with other DFIs. Other structures are being set up, but they are not big enough, you know. So there are examples in some countries where that happens. So that will be a kind of solution. To also be able to provide more capital to SMEs, mid-caps, that actually are the ones that they will buy from the smallholder farmers, because many of these companies, they need to have the capital to buy from the smallholder farmers. So if they don't have the capital, if they cannot grow, the smallholder farmers will be in a situation where they cannot market. So that's why I was referring or trying to focus on that, because the issue of smallholder farmers is a bit more complex from the commercial banking point of view. The commercial banks, obviously, they will try to focus on SMEs and mid-caps. And then I want to raise also something that Chris mentioned, and we have seen it also in Uganda when we set up the Yield Uganda Investment Fund, that we almost set it up at the same time that AgDevCO came to Uganda. We have seen in many cases that there is a complementarity between commercial banking, loans to companies, and private equity funds, you know, because the banks can focus on the working capital, and then private equity will focus on capex, you know, and we see that constantly happening. And for some reason, we don't see that commercial banks sometimes understand very well the business of private equity, and they don't come into the picture, or it's very difficult to bring them into the picture. So there is also another opportunity there that is somehow missed, that is to bring together private equity investors, Acumen, AgDevCO, and others that they are there in the market, together with commercial banks to jointly, I mean, you can do all kind of things. I mean, you can do syndicated loans, you can focus on working capital, the other ones can focus on something else. And it's not happening enough, you know, and that is also needed because that will allow a bigger pot of money being transferred into companies.
Thank you so much. And let me come back to you, Maxwell, TDB. Is TDB a commercial bank, by the way? Okay, so if it is, then I think part of what he was saying is applying to you. He's wondering why, despite these instruments that are being put together, why commercial banks are not, engaging and taking advantage of these instruments. So maybe you help us as you come to this question. But my real question is here. You've had all this. The need for financing remains huge. And there's always going to be a financing gap. What are some of the things that TBD is looking at to, at least from where you're at, to reduce the financing gap to the businesses that you're working with in the agricultural sector?
Okay, thank you very much, Madam Moderator. So in terms of widening and deepening the financial reach and financial inclusion, TDB is deploying a number of initiatives and innovations, and I can summarize them as collaborations, partnerships, co-financing, blended financing, offering financial guarantees to local institutions, especially for lending to the local farmers in local currency, and also we are looking at syndication and the use of financial intermediaries within countries. We have also an SME facility, as we have been talking about smallholders and their requirements and needs to just ensure inclusivity, especially given that the ticket size of most agribusinesses that we come across, they kind of require an amount or a ticket size which is relatively smaller. And these initiatives that I have just mentioned are important because different institutions, including TDB, have different risk appetite, they have different capacities, and also they have different ticket sizes. So these partnerships and collaboration try to give an overlap and an overlay on trying to make sure that the cross-section of agribusiness value chains are reached out.
So you have like 1 minute or so that we can allow a few questions?
Yeah,
so
okay. So the final one in terms of innovation is, as our CEO, Mr. Ori, has alluded to, is the first equity investment instrument, which was announced at the COP27, and the 15 million catalytic fund, which was provided the Africa Development Bank. And I think, as he said, for every dollar invested in the Class C shares of this is leveraging on 4 times for investment, sustainable agriculture and climate-smart agriculture. So those are some of the frontiers and efforts we are trying to roll out. Thank you.
No, thank you so much, and really thank you to the panelists. I think for me, what I pick out are 3 things. There's no single institution that is going to be able to do this. We are going to have to partner, we are going to have to collaborate better, and we are going to have to leverage each other. I didn't have a chance to talk about what we do at AGRA, but everything you don't want to do, we do. So, but let me open up for any questions from the audience. We have a few minutes to take questions. I can't see from here because of the light, but if you have a microphone and you can pass it on to a hand, please give them the microphone. Oh, you have a microphone? Please go ahead.
Well, one question I have particularly for Adolfo and Giovanni. Some donors are very enthusiastic about guarantee funds and all this, that as collateral, supplement to collateral of the banks, you know? But my experience in many countries, also working indirectly for donors or consultant, is it's really very difficult and very bureaucratic. Why? Because normally those who are managing the fund, the guarantee, they also want to assess the customer, assess the borrower. They go extra meetings and visit them. Then also the credit is more expensive because the guarantee costs also money. Yeah, it's a fee that's provided for that. So why are you so enthusiastic? And do you have really so good experience that we can continue treating as a supplement to collateral a guarantee fund, also partly also granted by the donors?
Okay, two people are called out. You want to go first, Adolfo? Yeah, please.
No, Guillermo, you are totally right. Now, my first reaction to that will be that guarantees schemes are many as companies exist. I mean, each guarantee scheme is very different. We have examples of guarantee schemes that they are very bureaucratic, as you say, and they don't work, and you don't see actually that the guarantees are being deployed for several reasons. Maybe because one of them is the process is too long, then the bank in the end gets fed up, or it's also expensive, as you mentioned. But there are also examples of guarantee schemes that they are working very well. And I think that the first, or at least the main actor that has to be engaged in a well-functioning guarantee scheme is the banks themselves. You know, we have seen guarantee companies that have been created with capital from the banks. Themselves, they put the capital there. So that means they are members of the board. That means that they drive the way that guarantee scheme works. Because it's for their own benefit to have a well-functioning guarantee scheme because they are guaranteeing themselves. You know, so I would say you are very right, but that's why it's very important to set up a guarantee scheme that is of enough size in this kind of.
Okay, so I'm going to cut you off.
Well. Okay, yes.
But thank you. I mean,
thank you so much.
Yeah, I think the point is extremely clear. Did you want to come in again? 1 minute.
Just 1 minute.
Just
yes.
1 minute,
yeah,
please.
Just to add that, yeah, I agree that many different guarantee schemes. I mean, they are all different. They are not two that look alike. But just to say that, yeah, some of those in which we have been involved, like the ones I mentioned in Malawi and Zambia, work differently a little bit from what you explained. And I think a key point is the right incentives. I mean, and agree with the local commercial banks that this is an incentive for them to go out there to be able to consider this high level of non-performing loans that some of them have in the sector, and to increase their appetite for the sector. But it should not make the loan more expensive for the final beneficiary. Thank you.
Okay, thank you. Any burning question somewhere?
Yes, just
Please,
one question.
quick,
Yeah?
just 1 second of your question.
Indeed. My question is about the clients. We've talked about capacity building on banks to understand agriculture risk.
Yes, the
but
question.
what about young people?
The question.
Young people getting into agriculture.
Okay, how do we get young people into agriculture? Any of you want to take the question?
Well, I think I did mention
yes.
that aspect of the training. Yes, we think that is key to be able to attract young people, attract also.
How?
Well, we do have commitments with some of the banks. For example, we get agreements with them that they have to, within the portfolio of the loan that we have, they have to comply, for example, when it comes to women, with the 2X challenge indicators in the sense of a minimum attribution to women-owned business within their entire portfolio, also with youth. So there are many banks actually that are interested in, also because it's a big chunk of their clientele, to be able to reach women and to reach youth.
Let me ask the women, right? Shiro. Sorry, not because you didn't answer it, but because I want to get their views as well. And Shiro, you have 1 minute or less.
I am happy
How
to.
do you employ youth and young and women?
Take a stab at it, which is to say that make farming remunerative, that indeed smallholder farmers are earning more than the cost of production. Then youth will go into it. It needs to become remunerative.
Very good, Ruja.
The other side of what was just said is also that we need education.
Yeah.
Youth needs to go into agriculture as professional workforce and take full advantage of new technologies and innovation in terms of post-production opportunities, manufacturing, value addition, and other services within the agri-food system.
Very good. Maxwell, the one thing that would bring youth into agriculture. I mean, would make you finance youth in agriculture.
Yeah, so I think
one thing.
Technology.
Technology, innovations. So, Chris, you know that I'm coming to you last. And what will it take for to actually recognize that being very deliberate to get young people is an important part of growing Africa's businesses? Do you have that consideration in your work?
So we'd approach it from the angle of employment, but growing, successful, mid-sized agri-businesses need a educated workforce, and we have brilliant young African managers in all our businesses, and they're being exposed to international standards, and they're progressing and doing great.
Very good. Listen, this has been a great panel. Don't you agree? Yeah. No, it's been a great panel. I really appreciate you taking the time and all the conversations you brought out. Like I said, I work for AGRA. We work with smallholder farmers. Smallholder farmers make money, my friend. They make money. And if you want to know, look at what happened, and some of the bankers will tell you, between 4 a.m. in the morning and 8 in the morning is when they make money. Just look at those people that are borrowing at that time. Yes, it's expensive. It's M-Pesa, it's expensive. But they actually borrow money because they are participating in the economy. If you come from Rwanda and it's a drought here and you're MTN, you will know the value of smallholder farmers because your sales go down. So please, respect us a bit. No? But listen, anything you can do to fund the upstream of things, to fund SMEs, it's how smallholder farmers get money, and we appreciate that and really appreciate what you all are doing. But you wanted to say something.
You see, I see the time is up. I wanted to tell you that my own grandfather was a smallholder farmer.
Very good.
You know?
Let's leave it at that.